As promised, City Union Bank, and we have Mr. N. Kamakodi, who is the Managing Director and CEO with us on the show. Good to have you on board. Given that we're looking at the banking system as a whole that is fairly benign, growth for you has been lagging in comparison. Your advances growth, for instance, is just about 2% on year. The systemic growth is about 13%. What exactly is it that's dragging your growth in comparison to the rest of the sector? Are you revising your growth targets? Earlier, it was between 12 to 25%.
Yeah, we typically used to have about 15 to 17 percentage 10-year CAGR over a period of almost 10 years up to COVID. After that, there was some disturbances when we, like say, almost stopped the onboarding of our core sector of MSME, and we managed with our gold loan portfolio along with the ECLGS. And after that, when we started, the system had a significant growth rate from the retail, particularly the consumption retail, both secured and unsecured retail, in which we are not there. At the meantime, we also started automation of our digital lending process. So because of this, we had to take a little bit slow to consolidate things, and we are in the process of putting the pieces together. So we should be able to get back to our, like say, closer to whatever we had during the pre-COVID period from the going forward. That is what for which we are all working together.
Okay. So any strategy that you may have put in place that you would like to highlight for advances growth from here on?
Basically, the most important change which is in the process of implementation is the digitization and automation of sanctioning process, particularly for the MSME sector, like a regulated retail portfolio below 7.5 crore. We have already started and implemented for like say customers less than 3 crore, and it is in the process of testing for up to 5 crore. And for most part of the next year, we should be having that up to 7.5 crore, which will significantly reduce both the turnaround time for the customers and also increase the make the decision making better, which is going to create a surplus capacity in the system, which is going to be a major change in the way we want to take it forward. It will be helping us to accelerate our growth also going forward.
You know, the other thing I also wanted to talk about, Mr. Kamakodi, was asset quality for your bank, because recoveries have been higher than slippages for you. NPA ratios as well are improving. What's leading to this kind of recovery, and you think it's sustainable?
Yeah, basically the as if you could have a look into the numbers for the last 3-4 years, particularly between 2020 to 2022, there was we before up to till 2020, for the previous 10 years, we used to have an average slippage ratio of about 1.5% to the closing advances, and we typically recover about 75 to 80% of the slippages on an ongoing basis. During the COVID period, the slippages increased to about from 1.5, it increased even up to 2.5 to 3%. And there was like a gap, particularly in terms of recovery, because the courts and all were not functioning. So that lag effect has started setting in, and this is sustainable for probably next financial year is what we see, and we are able to see the requirement in provision reduction close to about 100 to 150 crore year on year, which is helping us to take care of headwinds in profitability growth. Even though, like say, there were sluggishness in the growth, we are able to maintain the profitability growth because of the improved efficiency in the credit cost front, because of improved recovery over and above the slippage ratio. This as by and large setting, and we should be able to maintain this as we move forward.
The cost to income ratio, and how do you see that moving?
We normally we used to have between 40 to 42% is what we had, and since we had the investment in the digitization and all during this period, another 2-3% increase in the cost to income ratio is there. Progressively, we should be able to get back to 40 to 45%, and it should stabilize maybe in the next couple of years back to that original range of 40 to 42%.
My problem, I mean, not a problem, but my curiosity is centered around the fact that liability is like gold right now. Everybody is fighting for it. So at a time when there is fight for liability, won't your spreads come under pressure?
See, at any point of time, whatever I have seen in my last 2 decades of experience in the banking, you will always have pressure in one of the multiple parameters. It could be on liabilities for some time, it could be on asset growth for some time, it could be on the NPA and asset quality front on some time, and some issue or the other will be the constraint on a cyclical basis and ongoing basis. And now you are here, and normally what you see is that when the interest rate increases, the asset gets repriced quickly and the liabilities get slightly longer time to get repriced, and you will have expansionary margin during the increasing interest rate scenario. And whenever there is a you are entering into the decreasing interest rate scenario, there will always be some amount of pressure on that. And this is an ongoing exercise what a banker has to deal with on a continuous basis, and that's what every banking institution is prepared for.
Right. Okay, Mr. Kamakodi, great to have you on the show. Thank you so much for taking the time out and speaking with us.
Thank you.